Money, we earn it, we spend it, we save it. But how many of us actually control it? And let's be honest, no one teaches us how to manage money in school, not how to invest it, not how to budget it, not how to protect it from inflation, scams, and even our own bad habits. Welcome to the Money Show. I'm Kavita Thapliyal. Here we decode personal finance in plain English, break down the fine print and help you take back control of your money, one smart decision at a time. Whether you're figuring out how much insurance you really need, how to plan for retirement, or wondering if that mutual fund is actually right for you, we've got you covered, because in a world full of financial noise, you don't need more tips. You need clarity, and that's exactly what we are here to deliver. This is your money, your life, and your show. Well, even you can be a part of this show. Just in case you want to get your portfolio queries answered or your portfolio checked by our experts, you can send across your questions on our WhatsApp number, which is 865-797-4571. We also have an email ID, which is themoneyshow@etnow.tv, where you can send across your question and we can do your life financial planning on this show. So let's begin. Today, it's a very important concept that we'll be discussing on the show. In the world full of investing, everyone talks about returns, but the smartest investors know that risk-adjusted returns tells the real story. And when you want to measure how consistently a fund manager beats the market, not just by chance, but by skill, you need one metric that cuts through the noise, the information ratio. So here's the big question today. Is your fund manager truly outperforming the benchmark? And if yes, how efficiently, with how much risk, and how often? Today on the Money Show, we break it down. What is actually the information ratio? How is it calculated? Is it the real test of skill and not luck in portfolio management? Because when it comes to your money, information is your most valuable asset. So let's get started. I have with me Shweta Rajani, mutual funds head, Anand Rathi Wealth. Shweta, good evening and welcome to the show. All right, so the information ratio, now a new metric that actually talks about the skills that a fund manager has, and a very important skill as far as a portfolio management or fund management is concerned. How would you like to define it, explain it to our viewers in simple language?
Good evening, Kavita. Yes, another very relevant ratio which SEBI asked mutual fund houses to disclose, from 1st of May onwards in their fact sheets, put it in public domain there. Like you said, this is a risk-adjusted return measure. But however, there are other risk-adjusted return measures also available, like a Sharpe ratio or a ratio. How does an information ratio differ from the others, and what does it exactly do? I'll explain it in different parts. It basically is telling you, for every 1% of volatility that the investor would have experienced, what is the extra return that the fund manager has delivered. Now, the key here is how much extra return has the fund manager delivered. So what it does is the information ratio, as a step one, takes and computes what is the excess return delivered by the fund. For example, if the fund delivered a 15% return when the benchmark delivered a 12% return, the excess return is 3%. So this excess return comes in because of the fund manager's skill, because of the active management and the calls taken by the fund manager. Now, this excess return of 3%, let's say this was for an entire 1-year period. However, if you break it up into monthly returns, there would be some volatility, right? It's not that every month consistently the fund manager would have given like a 0.15% excess return, which added up, to the total. So the volatility of that excess return is then computed, and the information ratio measures for every 1% of that volatility of the extra return, how much did the fund manager deliver. So let's assume that 3% was the excess return, but the volatility of that excess return turned out to be 2%. So the information ratio, therefore, is 3 divided by 2, and that comes to around a 1.5, right? So what this is telling me is that, the extra return that the fund manager has delivered is clearly more than the volatility taken or the risk, bared for it. So it's a good indication that the fund is, the fund is giving you more return than the risk that the fund manager is taking. Two, it also highlights somewhere the consistency part. So if your information ratio is coming in at 1.5, it's telling you the fund managers capable in skills and consistently beating the benchmark. So the important point here is that it takes extra return and the volatility of that extra return. So you are keeping aside the market cycles and only focusing on what the fund manager has delivered for you. That's information ratio.
Sure. I also want to understand how can this ratio fluctuate as per market volatility? Is there any metric for that, or is it normal for it to fluctuate? Does it fluctuate? If it's fluctuating, is that the right sign? How can an investor understand the fluctuations in the information ratio then?
Absolutely. See, the good part about information ratio is that it is using excess return, which means it's return over and above the particular benchmark. So if you are in a scenario where, let's say, the market did not do well, markets delivered a -5% return. Even in that market, you would expect the fund manager to beat the benchmark, right? You would expect him not to fall as much as the benchmark has fallen. So if in such a scenario where market delivered -5 and the fund manager ends up delivering a -3% return, the fund has had an excess return of 2%. Let's say the volatility of that excess return was also 2%, then your information ratio is 1. On the other hand, another scenario where, let's say, the markets delivered a 15% return, you would expect the fund manager to also beat the benchmark in such a scenario and give you, let's assume, a 17-18% return. So here your excess return is again 2% for simplicity purpose, and the risk taken over here is, let's say, 1.5%. So you're expecting that your information ratio is also 1.2, 1.3. So the good part about information ratio is it, irrespective of what the market cycle is, your information ratio should not fluctuate much. It should be in a close range. A higher fluctuation in the information ratio is indicating to you that the fund manager is not consistent across market cycles, and you should avoid probably such fund managers.
Now we should be giving how much time for a fund to perform in this particular criteria? Should we be looking at the past performance or the current performance since the time you're invested in a fund?
So both are relevant. I would say when you are taking your decision of investing in a particular scheme, you'll have to look at the past information ratio. The only thing that I would suggest here is, you could look at the 3-year information ratio. It's a decent medium-term horizon and a time period given to a fund manager. But instead of looking at one 3-year period, look at multiple 3-year periods and something that we also call as a rolling period. So if across multiple 3-year periods, or if you're taking 1 year, then multiple 1-year periods, and see what has been the range of that information ratio. Is that consistent or no? And that will give you a better idea of whether you should invest with that fund manager. And once you have invested, you need to regularly monitor your investments, and ideally you should monitor your portfolio once every year in detail. So for your time period of investing, I would say you should look at max 1 year period, how the information ratio has fared, and then compare it to the other funds in the category in your own portfolio and take your decision if you should continue the fund or no. However, information ratio is just one ratio to be looked at. There are various other factors that should be considered when you are taking your investment decision.
I was just coming on to that because the other factors include what kind of metrics. This being the factor where you will be able to identify the expertise of the fund manager, capabilities of generating better returns as compared to a benchmark. But then apart from that, what other criteria or metrics should be kept in mind while selecting an active fund? And also the way to look at a fund manager's philosophy or strategy.
Absolutely. So, like I said, looking at information ratio is better than just looking at returns in isolation, because it's telling you risk adjusted, for the risk that you've taken, what's the return you've delivered. So that becomes one part. It's an actively managed fund. So one should look at what is the actively managed portion of portfolio. So higher the active portion, more possibility and probability of the fund manager to beat the index and have a higher IR or information ratio. One should look at how the underlying portfolio is constructed, and is that somewhere matching the current market scenario. So, the strategy that the fund manager is following, is it in line with the current market trends and what is expected out of the market? One classic example here, the style of the fund manager could be growth oriented versus what is likely to play out in the market is a value style. You have more value doing well. Therefore, is that match happening or no of the fund manager style versus the market situation? That is a third variable you should look at. You should look at stability and the research capability of the fund house. What are the stocks that are under their coverage? Do they have enough research support to get you the outperformance? So those are few other factors that one should consider when you are taking your investment decision in mutual funds.
Generally, a better information ratio is seen in large cap or mid cap category funds. I mean, I know it's a very fund manager specific question or a strategy, but where do we see a better ratio?
Sure. So, Kavita, we keep doing a lot of these analysis, and we had done one such study on a 3-year basis where we've seen which category has a higher information ratio and how many funds within that category had a positive information ratio. And the outcome of that, somewhere if I see categories like large cap had almost 70% of the funds having a positive information ratio. The highest that we'd seen was multi-cap as a category, where 77% of the funds had, a positive information ratio. Now, while I'm comparing these two categories, these are also categories which have similar number of funds that are, there. One has 31 funds, the other one has 37 odd funds in the category. So it's a reasonable size that you are looking at. But these two categories top the chart when we look at the possibility of you being able to pick a fund which had a positive or a higher information ratio. And a similar trend is something that I noticed even on a 5-year basis.
Quite interesting. So information ratio, or a criteria or a metric for you to pick up an active fund in your portfolio, one of the metrics that can be considered going ahead. But then let's take a short break, and post that let's connect with our viewers, because we have a few questions where viewers want to get their life financial planning done. Just in case you also want to send across your question, you can WhatsApp us your query and email us your question on our email ID. So let's take a quick break, and post that let's get connected with our viewers.